Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Energy Transfer stock so we can determine if it's a buy or a sell. Energy Transfer transports, sells, and stores natural gas, crude oil, natural gas liquids, and refined products. The company owns all Sunoco branded gas stations in the US. There are over 7,300 of them. If you want to invest in just the gas stations, you can simply invest in ticker SUN, S-U-N. They also own USA Compression Partners. That ticker is USAC. SUN's and USAC's financials are consolidated into ET's financials. ET is structured as an MLP, a master limited partnership, pays a lot less taxes than a traditional corporation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. The company is headquartered in Dallas, Texas, and was founded in 1996. Let's get started with the model. This is a large cap company, 41 billion market cap. They're trading at $13 a share, and they have 3.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went up a ton, 300% from 2020 to 2021. I think that's their highest ever, 8.3 billion. It came down in 2022 to 5.7 billion, but it's up in the trailing 12 months at 6.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. It was really small in 2020 due to asset impairments. Nearly 7 billion in 2021, and then 6 billion after that. Revenue is a sales for the company, and that looks really good. It goes up about 90% from 2020 to 2021, then up about 50% from 2021 to 2022. Almost 90 billion, their highest ever. In the trailing 12 months, it's 88 billion. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue is down from 20 billion to 19 billion. They give a nice breakdown of their revenue. Refined product sales, 5.5 billion. Because when you pull oil from the ground, it's pretty much useless. You have to refine it. By refining it, it turns it into something useful, like jet fuel, gasoline, petroleum. And that's pretty flat from last year, 5.4 billion to about 5.4 billion. Crude sales is up a little bit from 5.3 billion to 5.5 billion. Crude sales is before they refine it. So they would deliver the crude to the customer, maybe through their pipelines, and the customer would refine it. Natural gas liquid is down from 5.1 billion to 4.2 billion. Let's look at the pros and cons of natural gas liquids. Here are the pros. NGL is used in petrochemical feedstock that is turned into various chemical-based products. NGLs have many applications, including home heating, plastic production, and fuel. NGLs are much more widely available with horizontal drilling and fractionation. If you're not sure what that means, let's talk about it in the comments. The great thing about NGLs, especially with the shale boom, it's really added an additional stream of revenue for these oil and gas companies. And the growth in the US in NGLs has been phenomenal, which is great for 65% of my viewers, because 65% of my viewers live in the United States. There are negatives to NGLs. It's expensive to handle, store, and transport. The reason it's so expensive because when you handle it, when you ship it and store it, it has to have high pressure or low temperature to maintain that liquid state. The increase in NGL has led to increased demand for processing plants that separate NGLs from natural gas. They had 2.8 billion of gathering, transportation, and other fees. Most of their transportation is through their pipelines. Natural gas sales, 900 million. That's cut in half from last year. I think about 1/3 of the gas used in the US is natural gas. And natural gas is made of hydrogen, which means it produces fewer harmful emissions compared to gasoline. Because gasoline is composed of carbon compounds. And then other 227 million. In order to generate the 19 billion of revenue, the cost of products is 14.5 billion. Because they have to spend money getting the oil. They may buy it from someone else. They have to also spend money to refine it if it's refined product sales. Operating expenses 1 billion, depreciation and amortization 1.1 billion, SG&A 230 million. So total expenses 17 billion. which is down from last year. So their operating income is $2 billion. Last year was $1.8 billion. So let's look at their operating margins. We need their revenue, $18,995. Now we need their operating income, $2,062. To calculate their operating margins, it's operating income over revenue, which is 11%. So they converted 11% of their revenue into operating profit. The other 89% were expenses. Let's look at their operating margin last year to see if it got better or worse. So $24,991 revenue, operating income $1,846. So 9%. So it improved a lot. Their margins went from 9% to 11%. Much more profitable this year. Even 2% is pretty big because 2% of 19 billion really adds up. They spent $619 million of interest on their debt. Last year was $559 million. Their earnings from investments in other companies is $88 million. A loss of $20 million on derivatives, and in other a gain of $7 million. So their income before taxes is $1.5 billion. They pay very little taxes since they're an MLP, $71 million. So their net income is $1.4 billion, which is a little lower than last year. Let's look at their net income margin. So it's 8% this year, their net margins. Last year it was 7%. So they improved in both categories, operating margins and net profit margins. Last year their EPS was 38 cents. This year it's 32 cents. Here's a breakdown of their earnings per share. And the shares outstanding went up. Last year they had 3.08 billion shares outstanding. Now they have about 3.1 billion shares outstanding. Here's their operating section on their statement of cash flows. They reported an accounting profit of $1.4 billion in the first quarter of 2023, yet generated more than double of that in cash flow. They generated $3.4 billion from their operational business. I don't even need to look at the statement of cash flows to tell you why. Companies like this have so much in fixed assets. The pipelines are really expensive, all the infrastructure, the processing facilities, all of those items are capitalized. They're put onto the balance sheet and they're depreciated over its useful life. Depreciation is a non-cash item, so it brings down your net income. It makes your net income look weak, but it doesn't affect cash flow. That could be confusing for some people. Initially that confused me, but leave a comment and I can explain further. Last year they only generated $2.4 billion of cash flow with the same net income. The difference was changes in working capital. When you extend credit, that means you sell products or services and you don't receive any cash for it. You will receive it in the future. So when you use accounts receivables, it's a cash outflow in that accounting period. When you get paid for those products, it's a cash inflow. If you use accounts payable, you buy on credit, that's a cash inflow in that accounting period. But when you pay for those items, it's a cash outflow in that accounting period. Sometimes on the operating cash flow section, it lists all the changes in working capital, but they just summed it up here. But if you do look at a 10Q, it does break out this number. I thought this was interesting in their 10Q. They list their acquisitions in the first quarter, or at least their big acquisitions. If they made a small acquisition for a couple million, they might not list it here. Two notable acquisitions were Lotus Midstream and Sunoco. In May of 2023, ET acquired Lotus Midstream for $900 million in cash, and they also gave them $44.5 million of Energy Transfer common units. It's not called common stock because they're an MLP. They issue units, not stock. So they paid about $945 million for Lotus Midstream. Lotus owns and operates the Centurion pipeline. That's a pretty significant pipeline. It's an integrated crude midstream platform located in the Permian Basin. If you follow midstream companies, I'm sure you're familiar with the Permian Basin. Also in May of 2023, Sunoco, their subsidiary, they acquired 16 refined product terminals. And those were located across the East Coast and Midwest from Zenith Energy for $110 million. Let's go through their first quarter 2023 press release slides. And this slide is a summary of how they did in the first quarter. Midstream gathered volumes reached a new record. Interstate segment throughput reached a new record. Nederland Terminal set a new record for LPG and ethane exports. LPG is liquefied petroleum gas. Marcus Hook Terminal set a new record for ethane exports. Oasis Optimization added more than 60,000 million cubic feet per day of Permian takeaway. April of 2023, fractionation throughput at Mont Belvieu averaged more than 1 million barrels for the first time in a partnership history. Fractionation is a separation process of the oil and gas. Because in order to make ethane, butane, propane, there's certain ingredients involved. It's like baking a cake. You can't just do everything the same way. There's different measurements, different ingredients, different sizes, different quantities. They revised their 2023 guidance. Their expected adjusted EBITDA 13 to 13.5 billion, expected growth capital 2 billion. Their adjusted EBITDA for the first quarter was 3.4 billion, distributable cash flow 2 billion. I'm going to call it DCF, not discounted cash flow model, distributable cash flow. So DCF is a good measure for determining how successful an MLP is. The way it's calculated, they start with net income, then you add back depreciation and amortization, then you minus maintenance of CapEx. That's the general formula. Anytime you look at a non-GAAP item like this or free cash flow, you do have to take it with a grain of salt and maybe poke a little deeper. Because GAAP numbers like the income statement have to be reported a certain way. Non-GAAP numbers, there's a little flexibility. Excess cash flows after they pay dividends, 965 million, CapEx 400 million, maintenance 149 million, and they increased their quarterly dividend from 0.305 cents to 0.3075 cents. As we saw earlier, ET completed the acquisition of Lotus Midstream. That was a big one. They announced 250,000 billion barrels a day in natural gas liquid export expansion at Nederland. Cash distribution target of 3 to 5%. These slides are all from their press release. So far in 2023, ET is up 9%, while the Dow Jones Industrial Average is only up 3%. It also beat the Alerian MLP Index by 3%. Let me show you what that consists of. If you want exposure to MLPs, just invest in this index. This index invests in the following MLPs. 15% of the index is Magellan, 13% is Plains, Enterprise Products is 12.5%. ET is part of this, it's 12.5%. Even though this index only grew 3% in 2023, it looks like ET helped that growth. Other MLPs dragged it down. MPLX 12%, Western Midstream 12%, EnLink, Crestwood, Cheniere, and NewStar. Here's a breakdown of their Q1 adjusted EBITDA. 15% from crude oil, 27% from NGL and refined products, 19% from midstream, 11% from its subsidiaries Sun and USAC, 28% from natural gas, transportation, and storage. They explained a contract structure in case you were curious how they make money from these items. For midstream, it's the volume of energy they transport and store. They plan to add 2 billion of CapEx in 2023. Half of that comes from midstream, and that's from a cryogenic processing plant, a new treating capacity in Haynesville, efficiency improvements. 1/4 of that is in NGL and refined products. That's really concentrated in Mont Belvieu and Nederland. 15% interstate. That's to improve their existing pipelines. Also the new Gulf Run. 10% in crude. Projects associated with Lotus and new customer pipeline connections. And 5% in other. That's new customer pipeline connections, compression and optimization projects on existing pipelines. Here's a list of some of their major projects since 2017. The Bakken Pipeline, Rover Pipeline, Arrowhead 2 plant, Phase 2 of the Bayou Bridge, the Permian Express 4, Mariner East 2X, LPG expansions. So you can see ET is really big on growth. That's why I put a lot of money into ET. They're always acquiring companies and they're always developing new projects. Because why invest in the company if they could just sit on your cash? You want them to turn your cash into a 20, 30, 40% return. Half the company's owned by retail investors. I'm a retail investor. 13% by insiders, 38% by institutions. ET has a high insider ownership compared to its peers and the S&P 500. That's a good sign when the people who work at the company, the people who represent the company, want to invest in it. More than 60% of all US propane is exported, and ET is bullish that there will be a significant growth in international demand for many more years. If they are correct and export of US propane keeps going up, then this company will make a lot of money. You see, some slides aren't just about numbers. I like to look at things like acquisitions as well. These are some of their really big acquisitions since 2004. Sunoco, the gas stations. They own all the Sunoco gas stations in the US. Lotus Midstream, that's the most recent investment. Trans-Western Pipeline, that was a big one. Southern Union Company, lots of big acquisitions. Let's look at the capital structure. $33 billion of equity, $48 billion of debt. They have 41% equity, 59% debt. Their net debt is also $48 billion, so they don't have much cash on their balance sheet. They have a pretty high WACC, 12.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $75 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $68 billion. We divide that by 3.1 billion shares, and we get a calculated stock price of $22. They're trading at $13, so they're trading at a 40% discount. It's a really strong buy according to the model. Simply Wall Street's valuation is $18. They say the stock is 28% undervalued. 8 analysts priced this stock, and the average price target is 17, the low is 15, the high is 18. When you see a bunch of analysts pricing a stock, and the targets are close, then it's more likely it's going to hit that target. Another 16 analysts priced this stock, and the average price target is $17. They say it's 33% undervalued. They rated the analyst estimates as good. That means they're dependable. The analyst agreement range is spread less than 15% from the average. If it's a tight range, it's more dependable and it's good. If it's a wide range, it will be bad. This is where the stock has been trading since they IPO'd in 2006. Its lowest point ever was during the Great Recession. It was down to about $2. Imagine getting it for $2. That means your dividend yield will be like 60-70%. There was a huge bull run in oil in 2015, and the stock got to its highest point ever, breaking through $35. And what goes up must come down. Oil crashed in 2016, so did the stock price. It did come back up to $20, but then when COVID hit, it fell below $5. My cost basis is $864. I bought $50,000 worth in January 2022. So I'm up about 50%, and that doesn't include the dividend payments. A good way to track their stock price is to track the price of Brent crude. In the past 5 years, Brent crude is flat, while their stock is down 27%. They were moving in unison up through 2020. Then they just split apart. Oil went up a ton, but came down quite a bit, while their stock has been slowly increasing ever since 2021. When you buy a stock, especially a commodity stock, timing is kind of important. So if you bought it at the wrong time, you may never get your money back. Because if you bought this stock when oil peaked, then it's likely you're going to wait a really long time for oil to get back up to over $120 a barrel. If you buy this stock when oil is $50 a barrel, you could retire, assuming you buy enough shares. But if you buy the stock when oil is $80 a barrel, you'll probably just do okay. They pay a really nice dividend. It was 31 cents in 2018. They cut it during COVID when their stock crashed. Now it's back to where it was at 31 cents, and that's a big yield, 9.5%. Not only have my shares gone up 50% since I bought it, I'm also getting a 9.5% yield. That's 59% of their free cash flow, 66% of their net income. There are 53 companies in the same industry as ET, and ET has a better number than the median in every category. They spent a ton in CapEx, $3.5 billion, a little behind Enbridge, a good amount behind TC. Their debt to equity ratio is equal to the median. For every dollar of equity, they have $1.50 of debt. If you're an MLP, you really need to take on debt, because most of your profits go back to your investors in the form of a dividend. So in order to grow, acquire companies, scale, you need to take on debt. They pay one of the highest dividends on the list. They generate lots of free cash flow. Look at Cheniere, nearly $9 billion, pretty impressive. They rank 4th in market cap, a little behind TC, a good amount behind Enbridge and Enterprise. Their price to book is really good at 1.1. PE is also really good at 6.4. Price to free cash flow is great at 6.7, and price to sales is 0.4. That means their revenue is more than double their market cap. By far, they have the most revenue out of any company on this list, and they're still growing. Their 5-year annual revenue growth rate is 16%. Enbridge is 0. TC is only 1%. Enterprise is good at 13%. Look at Cheniere, 38%. Maybe we should be buying Cheniere. So to summarize, I have them trading at a 40% discount. They've been around 27 years, and they're one of my top 5 holdings, along with Costco, Meta, Johnson & Johnson, and Berkshire Hathaway. So I'm super bullish on this stock. It's my favorite midstream. ONEOK is my second favorite midstream. I like the management of the company. I like how they're always looking to take on new projects, acquire other companies. That's the name of the game. Grow, scale, build. I rank their free cash flows and revenue 7 out of 10. Their ratio is 10 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.